Hello, everyone. Welcome back to another Lunch and Learn webinar series. My name is Mayur Thaker. I am an equity strategist here at Zacks Investment Research. And today I am making a pitch, an investment pitch on Oracle Corporation. It's ticker ORCL. Everyone has heard of it. And in this presentation, I am making the case that this current bear market in shares of Oracle is one of the most extraordinary buying opportunities to acquire shares of an extraordinary business with an equally extraordinary story that they have already told for 30 plus years and are now retelling in the new age of AI. So here is my investment thesis on Oracle, their AI data center bet, the moat, and addressing some of the key concerns that people have put forth regarding the risk that exists on the balance sheet. So let's take a look. So here is a brief overview of what we're going to talk about in this video. We're going to just start with a quick business overview and moat, sort of an introduction into what Oracle is and what they do, what they're working on as chapter two in terms of their cloud and AI data center build out. Take a look at their unique opportunities, the unique position that they're in to monetize that effort, what the financial trajectory of the business is. And then we'll take a look at some of the concerns that people have put forth regarding the balance sheet. And in particular, I would like to show an adjusted sort of metric that helps put the debt that the company has in better context. And then we'll take a look at some valuation and price targets at the very end. So first, Oracle's economic moat. This is the most important thing when it comes to making an investment decision for a long-term position, that is, companies that we're betting on. We want or would like to see the company sitting on an economic moat. Why? Because an economic moat helps protect your investment, right? Just think about moats in the old days. The reason for building a moat is to protect yourself. And the same thing goes with regards to making an investment in a company, a long-term investment. We'd like to see a strong moat, something that protects the company from competition, something that the company does fundamentally that's better than everybody else because of scale, because of R&D leadership, because of other factors too, like regulatory capture or network effects, things like that. And Oracle has a little bit of all of these, all wrapped up into one company. Number one, they have deep database entrenchment. The world's largest companies run on Oracle. This is mission critical enterprise workloads. They all run on Oracle database, creating high migration cost and risk for customers. Because again, this is where proprietary data for thousands upon thousands of companies reside. And to migrate that data is a painstaking effort, takes a lot of time, a lot of cost, and just a lot of headache. So that's why Oracle enjoys some of the best retention rates in the industry. Um, Number two, multi-cloud distribution. This means that Oracle database, um, with AWS, Azure, Google Cloud, they all embed Oracle inside rival hyperscaler ecosystems. This widens their reach without ceding control. And number three, contracted revenue visibility. Every software company reports RPOs, that's remaining performance obligations. This is basically contracted revenue that they cannot yet recognize as revenue. It just means that this revenue exists in theory and is just waiting for the company to deliver those obligations. And when they are delivered is when the company can book it as revenue. So this provides a lot of visibility into future revenue. So it's a very important metric. RPOs now sit at $638 billion. as of the company's fiscal year 2026 year end. That locks in years of demand into the future. So this is a very, very strong number, and it's based on the strength of Oracle's economic moat. They are, the standard bearer when it comes to enterprise software, ERP software, as they call it. This is again the place where the world comes to store, organize, and retrieve their own proprietary data. So this is where the AI data center bet unfolds. Oracle Cloud Infrastructure, that's OCI, is scaling into one of the largest AI compute buildouts in the entire industry and really the world. Um, this, again, is leveraging the fact that they have an enormous RPO balance, right? So the $638 billion that they just reported last quarter, that represents a 663% increase year over year. So this is just an incredible surge in demand for Oracle products and Oracle services. Um, the Oracle Cloud Infrastructure division um, has reported 93% revenue growth. 93% revenue growth. Um, the company's also committed about $55 billion in total capex for this year. That's one of the reasons why the shares are down so much, is because investors are worried about the size of the investments and the amount of debt that the company has strapped onto itself in order to finance it. Um, and for fiscal year 2027, that number is getting even bigger, growing from 55 billion to 70 billion dollars. This is again one of the main reasons why shares are down more than 50% is because the market believes that they're getting a little too aggressive with the AI capex commitments. Um, in addition to the fact that a lot of these RPOs are tied to basically one or two customers, primarily OpenAI. And so a lot of people are discounting the size of this number. They think it's not real because a lot of it is coming from OpenAI, and OpenAI simply doesn't have the cash to actually follow through on its commitments. That's the criticism so far. But I believe that that is mostly priced into the valuation today, which basically gives um, all of this number a risk-free call option to the upside. So in case this actually comes to pass, then you're going to see a Super Bowl scenario for the shares that you would be taking advantage of in a big way today, given the fact that the shares are down still roughly 50% from its all-time highs, trading at roughly 144 per share today. If this number comes in even within the ballpark, then you're going to see an acceleration in the stock price to the upside like we've never seen for this particular company, at least, and especially within the large cap space. This is going to be sort of like an NVIDIA moment if confidence grows in this number. But as of right now, the RPO continues to build every quarter that they report revenue, every quarter that they report earnings. And so I think that eventually the market will recognize that and will respect that um, as we get closer and start to see some of these RPOs actually translate into real revenue growth, which they're already doing, by the way. As you can see here, 93% growth for OCI. That is staggering. And yet shares are down heavily because the market does not believe that this is going to be sustainable, that this number is ever going to come to fruition. But every quarter, as we see more and more progress, we will start to see some of this RPO flow into the revenue, the top line, and that will be the trigger for when the market reprices Oracle to the upside, in my view. Another reason why I love Oracle, they've got a captive audience that nobody else has. Oracle database already sits inside of the world's largest enterprises, like I mentioned, running mission critical systems those companies cannot easily replace. Again, companies store financial data, ERP, transactional data, all of their proprietary data. Imagine all of the proprietary data that various companies have, such as banks, industrials, other software companies, um, companies across the board, across industries. They have, customer data, they have financial transaction data, they have financial statements data. They have the entire corporate ledger that they need to be storing in a centralized database. Oracle is where all of that data lives, and not just for a couple of companies, but for the largest companies and government agencies across the world. This is decades of embedded, entrenched processes that simply do not change. They do not move. They don't go from Oracle to other providers. Once in the Oracle environment, it becomes exceedingly difficult and exceedingly rare for companies to leave this ecosystem. And that's what makes Oracle in such a unique position to monetize the data that they already have in a new way, given the new abilities that frontier models and even small language models can provide them. So again, no new sales motion required. Data never has to move. Again, these are all reasons why I believe Oracle is a high conviction bet. And Oracle Executive Chairman Larry Ellison, founder as well, um, he has stated that your competitive advantage doesn't come from public data. It comes from your proprietary customer data, your operational data, your industry specific knowledge. And that is a thesis Oracle is uniquely positioned to monetize given where that data already lives. So again, this is, in my view, one of the most compelling investment opportunities in the entire market right now, given how much shares have declined, despite the recurring revenue nature of Oracle and the fact that the world's most important, most sensitive, most sacred corporate data lives in Oracle databases. That gives Oracle a unique opportunity to leverage that advantage with AI. So monetizing AI without exposing the data. So Oracle database, that's 23 AI, 26 AI, brings AI directly to where enterprise data already lives, rather than requiring that data to be extracted and handed to a third party. So this is all native within Oracle. It does not need to be extracted to third-party providers like OpenAI or like Anthropic. Which has the large language models. They are the frontier labs, but they don't have access to the proprietary data that Oracle does. So this is a technical advantage that Oracle has over pretty much everybody else. Other technical advantages: native AI vector search lets structured, unstructured, JSON, graph, and vector data be queried together in one converged database. Again, allows for synchronicity. It allows for queries to be, performed across different databases, all within Oracle. So this is again a major advantage, and this is why competitors cannot easily replicate, right? Because Oracle controls the full stack. They control the infrastructure layer, that's OCI. They control the database layer where proprietary data resides, and they control the application layer, which is, Oracle Fusion and NetSuite, where that data is generated. And competing hyperscalers can offer compute, but they do not natively hold decades of the largest companies, largest enterprises' transactional and operational data, right? Meaning Oracle can monetize AI as a data adjacency play rather than a pure infrastructure rental business. Again, this is why Oracle is so unique. They will generate revenue, high margin revenue from pure infrastructure rental, right? Meaning being able to sell some of the compute that they have bought. But alongside that, the ROI for Oracle is going to be even greater, in my view, because they're not reliant on just the compute rental business, which is what every other data center is doing. They are both a compute rental business and a service that will be able to cross-sell existing customers with AI armed agents so that it allows companies to query their own data in ways that they've never been able to do before. Again, entirely because all of their data lives in Oracle. So this is two ways that Oracle is going to be able to monetize all of this data center spending. That is a major advantage that Oracle has over the standard data center business model. Core business trajectory, they did report for fiscal year 2026, $67 billion of revenue. That was a 17% jump year over year. Again, very, very solid results. The cloud revenue has reached $34 billion. That's a 39% year-over-year increase. And 2026 non-GAAP earnings per share at $7.63. That's a 27% jump year over year. The only reason why this number is lower than the top line is because they're currently in the build-out stage, which is why margins suffer again during the investment cycle. During the rapid and aggressive investment cycle, margins do suffer, but you will see, in my view, substantial operating leverage start to kick in beginning next year and accelerating even more in 2028 once they begin monetizing the data centers that they have built using that two-step business model. Number one, data center rental, again, which is the standard business model that everybody else is running, but also because the company will be able to cross-sell AI services to their thousands of large-scale clients. Um, Now we'll take a look at some of the earnings consensus numbers. Again, pulled by Zacks earnings estimate revisions and Zacks rank momentum they do support a constructive near-term view. Oracle currently carries a Zacks rank of number 2, which is a buy. Remember, the Zacks rank is our proprietary earnings estimate momentum model. This looks at the strength of earnings estimate revisions, and it currently does rank as a number 2, which is a buy, with the Zacks consensus 2027 EPS estimate revised upward 0.27%, not a lot, but still a lot bigger over a longer time frame, but just 0.27% over the past month. We can see that 2028 earnings per share growth is estimated to be 33%. Again, the reason why that is, you can see that right here. 2026, the final number, which is the actual number, was $7.63 per share. Next year, we expect that to accelerate to $8.03, but then the big number, the big results, start coming in fiscal year 2028, where we believe that earnings will accelerate by 33% year over year. And again, the reason for that is the dual-pronged business model that I believe Oracle will be running at full scale by 2028. However, I think these results will start to get priced in about a year in advance of that. So at some point next year, probably early next year, I can see Oracle re-rating to, a potentially a 40 multiple, potentially as high as a 40 PE on 2028 numbers. Why do I say that? It's because this is a recurring revenue business. Um, Oracle is not a cyclical business. They are recurring revenue in nature. They are a SaaS business at the end of the day, and they have substantial uh, capture of their clients who renew at almost a 100% renewal rate every single year. Net dollar retention is also very, very high, among the highest in the software industry, which is why we can assign a tech-like multiple to these earnings because, again, they are not cyclical. They will be repeat. They will be sustainable and supportable for the long term. And so that's why in a bull case scenario, I can see a 40 PE on $10 earnings per share. That leads to a price target of $400 per share. Again, today's price, 144. Now let's address the debt concern. This is the main one of the main reasons why shares are down so much. The company now is sitting on a staggering $156 billion of debt as of 2026 year end. Um, However, I think we have to put some of that into context properly. I believe the best number to contextualize debt is net debt to EBITDA. So we have to look at debt and net it against cash and look at that netted number against EBITDA. So if we look at total debt, it looks very large and it's growing significantly. But if you compare that versus cash, right, the net debt drops to about 124 billion, still a very high number. But then if you look at it relative to EBITDA, 2026 EBITDA, um, that is roughly a 4 multiple. Net debt to EBITDA is roughly 4 times. Um, that isn't terrible, right? So if you look at that again, net debt to EBITDA, I believe that that is high, but still within a normal range for investment grade companies. We do have investment grade companies that can get to net debt to EBITDA this high, especially for a company like Oracle, which does not have cyclicality. Remember, this is not a cyclical business. This is not a automaker. This is not a industrial that is subject to rising and falling demand. This is not a consumer discretionary company. This is not a retail company, a retail store, because again, these are all industries that go through cycles. As consumers get strong, revenue and earnings go up, and as they pare back, revenue and earnings go down. This is not a company that is in that category. This is a company that does not have cyclicality. And you can see on this chart, this is a chart of the stock price overlaid with earnings per share. Again, exactly what Peter Lynch loved to look at, looking at stock prices relative to earnings over time. And you can see the company has very stable earnings growth, very supportable earnings growth. Again, because this is a business that is built on software as a service. And it's not just a software as a service, but it is a mission critical software as a service. It is a software that is required. It's not a nice to have. And it is where all of the company's most sacred and most critical, mission critical data resides. So this is not an option. This is a required um, commitment for companies. Companies basically put the bill that they get from Oracle into their annual budgets. So it's already factored in, it's already budgeted pretty much every year by companies. And that's why I believe a company that has an earnings stream like this, a company whose nature is such that they are a criticality, not a discretionary expense, for them to be able to lever to this extent. And again, 4 times leverage is high, but it's not dangerously high. There are other companies that do have an investment grade credit rating that do have net debt to EBITDA multiples this high, especially when they have very high visibility revenue and recurring revenue. Those are the two factors. And again, given the fact that Oracle has such incredible RPO, right? The remaining performance obligations are so high that that gives us even greater certainty that this earnings stream that we just saw here is going to be supportable and repeatable. So again, I believe that this is a EBITDA, net debt to EBITDA multiple. This is an effective leverage ratio. I believe that that is normal, especially for a company like Oracle, where you can say with relatively high confidence what next year's revenue and earnings are going to look like. For a company with that level of certainty into the future, we can have, and it's very normal to see leverage ratios this high at 4 times. I believe that is still within range, and I don't believe that I believe that the market has overpriced this as a risk, which is why shares right now, I believe, are trading at an extraordinary deep value opportunity. So again, if you just take the base case, right? Let's forget about the bull case scenarios, but if you take a base case scenario, we look at next year's consensus EPS forecast, which is about $8 a share. And if we apply a multiple of 22 times, that's roughly the 5-year median forward PE for Oracle. That gives us a 180 price target. That's still 24% up from today's price at 144 a share. So again, base case, we'll walk away with still a handsome profit over the next year, 24%. But if you look at the bull case, and again, this isn't even the biggest bull case. This is I guess you can call it a reasonable bull case. And that is if you take the 2028 earnings consensus, which is $10.69, and apply a 26 multiple, okay, that's still well below the 5-year high of a 60 multiple. You just apply a 26 multiple to that. That gives you a price target of 278 per share. That's almost a doubling from today's price. So I believe that this represents a substantial um, asymmetric risk reward to the upside in shares right now. And that's why we have current price targets, in the range of 180 all the way up to 400. That is the high price target that that we currently are collecting from the sell side at $400 per share. And that is basically where I came up with the original target, which is a 40 multiple on $10 of earnings per share, which can easily get us there. So this is a very, very asymmetric opportunity to the upside over the next very short term, 1 to 2 year time frame. I believe you will be able to double your money or more. Key risks to monitor: execution risk on data center capacity. Remember, Oracle must physically build and energize capacity fast enough to convert these RPOs into revenue. Remember, these RPOs are waiting for Oracle's capability to come online. Once they do, then we can start to see some of this translate into real revenue. And then we'll also see, whether OpenAI can follow through on its commitments as well. So I believe that these are free call options to the upside because given the fact that the stock is down so much, I believe that the skepticism around this number is already priced in. Shares of Oracle right now, remember, they trade for 4 PE of 15 or 16. Let's just take a look at that right now in our, nifty Zacks Research system. Yeah, the current forward PE is about 16 times. You can see how much the multiple has crashed down, ever since concerns started to rise about the debt load and about OpenAI's ability to follow through on its commitments. It's trading for a 16 forward multiple. That's right inside of the range that it's been at for years and years. And so right now, we just erased the entire AI premium that the company once had, starting in 2023 and really accelerating, going parabolic late last year. That premium has entirely evaporated now. And so that's why I believe right now represents asymmetric um, upside, potential relative to the downside. Again, because if there is some confidence that returns to this number, we will see a very sharp re-rating of shares back to what we saw around this time right here, somewhere in the range of 2023 to 2025. Perhaps a 25 multiple, perhaps a 30 multiple, somewhere in that range. And you can see that if it just gets back to a 25 multiple again, which is very reasonable for a company with recurring revenue the way Oracle has, and very strong revenue growth the way Oracle has, that represents a substantial upside to the stock price. So again, I believe that some of these risks are already priced in. Continued negative free cash flow, that's another risk to monitor. Free cash flow was negative 23 billion this past fiscal year. Further debt and equity issuance could pressure per share metrics if mistimed. Customer concentration is another risk. More than 300 billion of RPOs are tied to a small number of very large AI customers, especially OpenAI. That raises some counterparty risk. And valuation premium. It did trade at a premium, but again, this has been mitigated almost entirely. So this right now, as of today, is not even a risk in my view. And the other risks, I believe, again, my opinion only, not the opinion of Zacks, but I believe that a great majority of these risks are already priced in, given that the AI acceleration premium has entirely been evaporated. And we're back to forward PEs now that are very normal, for Oracle. So again, valuation wise, this is a very compelling opportunity in my view. So I'd love to hear any feedback, any questions. If you have any, please do reach out to us. I will do a video on this very video that I did. We'll review some of the statements I made here. We'll see if I, ended up being right. I will do that at some point early next year. But in the meantime, if you have any questions on any of this or any feedback, please do reach out to us at 1-866-794-6065, or you can send us an email to strategydesk@zackspro.com. And once again, I appreciate your time. Hope you found this helpful, and see you again soon. Take care.